Hello, McDonald's? Hi. No, I don't want to order any food. I was just wondering, do you by any chance have any job vacancies? My previous experience? I was a crypto millionaire. What is day trading and how do you start? In this video, we will cover this topic and some basic principles and examples of placing trades. Hello everyone, my name is Dan, and in this video we'll be diving further into more technical stuff when it comes to day trading. So get your notepads ready and let's go. Alright, you got motivated, got your money ready, deposited into your account. You saw a video of a guy flashing a Lamborghini, throwing money in the air while working 1 hour a day somewhere in the beach, and you think to yourself, yes, I got this, I'm ready. Newsflash, you're not. Well, not yet at least. But you made the first step and here you are. So once you've done with all the formalities, as I mentioned already, as account opening, choosing the financial instrument to trade, which you can find by the way in the previous videos if you haven't looked at them, let's dive in deeper into more technical stuff. However, let's first cover once again in simple terms what is day trading. It is a form of active trading where you buy and sell financial assets within a day. Sometimes you hold your positions, let's say a few seconds, up to a few minutes or a few hours, but the important thing is that you close your positions by the end of the trading day. Benefits of closing your positions by the end of the trading day is that you reduce your exposure and risk to the market, because let's say overnight there can be some big news or something happening in the world, like some macroeconomic movements, like for example war in Ukraine or similar cases, and you have your positions open, right? So you're exposing yourself to that risk, and in the morning when you wake up you see a big losses, right? You want to avoid that. That's what is day trading is good for. Of course, day trading has its own other risks, which we'll be covering later on, but stay tuned for that. Now let's move to the PC. Let's move on with the fun stuff, technical stuff, and I will be showing you everything from the beginning, from the start. So once you sit in front of your PC and once you start your trading journey, so you're ready, you know what you see, you know what the chart consists of, etc. So let's dive in. Okay, let's move in onto the chart. So what do we see on the chart? Of course we see candles, right? The green candles represent the price movement going to the upside, and the red candles represent the price movement going to the downside. Then we see time at the bottom. I use UTC, however you can use any time zone you want, it doesn't matter. On the right hand side we see current price, and on the left upper corner we see two very important buttons, which is buy market and sell market. Okay, so these are just the quick buttons. But what does buy market mean? That means that you are based on your analysis saying or predicting that the price will go up. And sell or short sell means that based on your analysis you think that the market price will go down. Alright, let's move on to the types of orders. Okay, we have three types of orders, which are market order, limit order, and a stop order. The first order that we'll be going over is a market order. What does a market order mean? It is a type of order to buy or sell a product, and it is executed instantly at the current best market price. What does that mean? Well, that means that for example, I want to buy a Nasdaq right away. I saw a pattern or indicator gave me a signal or something, and I want to buy it right away. I will be going and pressing the market order, and boom, it should be executed. Yeah, so the trade is executed at the current best market price. When the market is very volatile, okay, sometimes let's say you press buy and the price when you pressed buy was 12,114, okay, you press buy at that time, but because so many people pressed buy at the same second, you got filled, your order got filled at 12,120, like $6 higher than you wanted to pay. But this is how it works, and you should be only using market order when trading indicators or some high conviction trades. The next type of order that we're going to be covering is limit order. Limit order is a type of order where you set a maximum price that you're willing to pay or minimum price that you're willing to receive. So basically, let's say you want to buy Nasdaq but only at a price of 11,900. Okay, I will place the order now. Boom, you see the blue line? This is where our order is. So if the price retracts and comes back to this blue line, our order will be filled, okay? And it will be filled at a specific price of 11,900. So limit order is way better because it gives you exact price that you're willing to pay, and it gives you exact price that suits you. And the last type of order that we're going to be covering is a stop order. Stop order is very similar to limit order, however there's a small catch. Let's say you want to buy Nasdaq at 12,200, okay? You place your order, see, there it is, it's a blue line. However, once the price reaches this blue line, it will be executed at a market price, okay? So that does not guarantee you that you're going to be filled at 12,200 exactly. You might get filled at 12,220 if the volatility is huge at that level, okay? So this is just a small difference between the limit and a stop order. Also, there is a stop loss and take profit order. Basically what that means is, let's say you want to risk only $20 in order to make $60 per trade. All right, which is 3 to 1 risk to reward ratio, which I use. It's part of my algorithm. I don't usually go below 3 to 1 risk to reward ratio because this is what keeps you profitable in the long run. However, I'll be covering that a bit later on. Let's say you're willing to risk $20. Price retracts, goes down, and you're losing $18. Your trade will not be closed, but once it reaches $20, your trade will be closed automatically. Basically, it's a stop loss, protecting you to lose more money than you want. Same goes for the take profit, which is if the price reaches $60 of profit, it will close automatically, and that's it. All right, let's move on. Now we will be talking about time frames to trade. So this is a 1 hour chart, okay, that we're looking at the moment. What I suggest to beginners is to trade 1 hour chart combined with 15-minute chart as a zoom. Why? Because most of the day traders actually trade 5 minutes combined with 1 minute or even less. Some traders even use 10-20 seconds. All right, me personally, I use 5 minutes with 1 minute combined, but it takes a lot of practice. It takes a lot of discipline and a lot of knowledge in patterns, in price action movements to master that. By using higher time frame, it gives you less volatility in the market, and it gives you a better zoom out and better outlook on the trend and current happenings in the market. So I would suggest you, for beginners, to start using 1 hour combined with 15-minute trade and to take patterns and signals and everything from there. However, if you don't really have the time to trade and you just want to place like one trade a week or something, then you can go over to 1 day chart and combine it with a 4 hour chart, and then just take your options from there. The next thing that I want to talk to you about are key market levels. I'll be just briefly showing you now how I mark key market levels, but in the next video I will do a separate topic which will cover in-depth key market levels, everything you need to know about them and how to mark them properly. So let's say on this chart I will mark a key market level right here, for example, and based on this key market level I will be trading. So what does this key market level represent? It represents an area in price where the price didn't manage to close higher or lower. For example, see right here, this is the beginning of the key market level. Then we retested it in the area over here. We did manage to break it, we went down. Then we were slowly climbing upwards. We didn't have enough momentum to reach it here. We went down. Then we just came here to touch it, and then we again retraced back. Then we came to this area right here, and then we were fighting a little bit around this area and finally managed to break it. There was an impulse and we managed to go upwards. So what is the strategy around key market levels? Okay, the strategy around it is, let me just take this brush here. If the price decides to retract and go back, okay, and reaches this key market level, you will be going into long position. Long position means that you will be buying, okay? Why? Because you see here that the market level was representing an area of resistance, okay? All these points right here and here as well. Now we are expecting from this key market level to turn into a support area, okay? And then if it retraces back and then the market bounces back off of it, it will be area of support. This key market level will be turned into a support. If the price goes to this key market level and then continues going down, this is what we call a false break, okay? That means that this impulse right here was actually false. It wasn't continuous and strong enough to maintain it above the level, and it was pushed again down below the price. So if we get stopped out, let me just delete this real quick. If we get stopped out over here in this area, right, what we want to do is we want to be on the sell side, okay? So if we see that we cannot maintain the momentum and we cannot maintain to be above this area, okay, above the key market level, we are going to be opening a short position and we are going to be betting that the price will be continuing in the downtrend. All right, so this is just one simple strategy using the key market levels and playing around them. Basically, what you want to go and what you want to trade around the key market levels are either a true break, which is this, okay, this right here is a true break because we broke above the level, we consolidated a bit, and then we continued upwards. So now it's considered as a true break. Or if, as I said, this reverses back down, then this is going to be a false break, meaning that we didn't have enough impulse to stay above it. Key market levels will be combined with indicators. Again, I'll be covering that separately in order to give you a better understanding of the price action movement, impulses, how strong is the trend, and can you actually trust the trend. So basically, let's say this trend here, all right, we've been just trending upwards since what, 16th of June, right? Now what we want to look for in the trend in short terms, in like 5-minute frames, we want to look for weaknesses, okay? And we want to exploit those weaknesses. Whenever you find a weakness in the trend, you want to trade it. You want to take a trade against the trend or in the trend. If it's a weakness, you take the trade against the trend. If you find a confirmation, then you trade with the trend. Okay, let's say that the price started reversing back, all right? It came to this level and you decided to take a long trade because it was a false break. It just broke through and it went back up, all right? You took the long trade. However, the price reversed just to continue downwards and hit your stop loss. When you see things like this, you don't touch the trade, you let it play out. This is very important. And why is it very important? Because you will then log into your trading statistic this trade. You'll write down where did you take it, at which key market level, how strong was the level, how was the price reacting before, etc. I will teach you how to make your own trading statistic. And later on, when you compile a certain amount of data, you will analyze all those data and then you will have a proper view of what is actually working for you and what is not working. Maybe this will not be working for you. Maybe key market levels is not a strategy that is going to be profitable for you. I don't know. For me, it is, but it doesn't have to be that it's going to be profitable for you. So you can try out something else. You can try different types of trade. You can try trading some indicators or whatever you feel like. You can back test anything you want. What is important is to log those trades, and once you get compiled the data, enough amount of data, then you analyze them, go over them and see what is actually working. Are you better on the long side, buying side? Are you better on the short side? Are you better as a short seller? And then you will see what are your strengths and what are your weaknesses and what do you need to work on and which strategy is actually working for you and which strategy is not working. Because trust me, not every strategy is 100%. Not only that, not every strategy, but there's very few strategies that have high win percentage ratio. And when I see people on the internet claiming that they have 90+%, I find it very questionable because there's so many of these fake forex gurus that gives you signals to trade for a certain amount of money, and I just find that very, you know, deceiving. And these, I mean, if they have 90+% win rate, then they would be not only millionaires but, I don't know, billionaires, right? Because they would be able to compound their way up to infinity. In order to be profitable with 3-to-1 risk to return ratio, you only need to be profitable around 40-45% of the time, and that's enough. Your strategy doesn't have to be 60-70% win ratio. If it is, it's even better, and then soon you'll be going to a Lamborghini shop asking them to recommend you a vehicle. But yeah, in reality, 40-50% is good enough. And even if you don't use 3-to-1, if you use, let's say, 2-to-1, you can still be profitable. You just need to you manage your risks accordingly, take only good trades, and then leave the garbage trades to the garbage traders. So and that's about it. One of the things that I'm personally using also is a 3-rule stop. Basically, if I make 3 losing trades, I stop trading for a bit, at least, sometimes even for a day, but I stop trading even for a bit, because your psychology gets triggered, right? You get emotional, you get into revenge trading, you want to take that money back that the market makers took away from you. You want it back because it's yours, because it belongs to you, right? And you go into this unreasonable and unrational mode where you don't see anything. You just start seeing things up that are not there, and you're just gonna be starting clicking buttons randomly, and you're gonna be losing money. You're just gonna blow up accounts, which happened to me. I blow up accounts, did all those things, revenge trading, over trading. But you can fix everything with proper work on yourself, on discipline, on your mindset, and with proper algorithm in place, with proper rules that you're going to be following. And if you break those rules, that's it. You're out of the trade or out of the trading for the day. So that'll be it for today's video. It was a short one. Stay tuned for the next one. Now we're going really deep technical. This was just scratching the surface, where I'm going to be fully covering key market levels, how to identify them, what are the types of key market levels, how they're created, etc. So make sure to click that like button, subscribe to the channel, turn on the notification bell to be notified whenever I post a new video. Stay tuned for the next one, and have a great day.